Hi, I'm James Robinson, and this is my stock pick of the week. This is part 3 on my series on RYAAY. Today we're going to talk about balance sheet. Also, I should note we're not going to do a video on dividends because RYAAY doesn't pay a dividend. So what am I looking at with balance sheet for a company? Well, so balance sheet is really a look at the company's assets and the company's liabilities. More importantly, what you're looking at is there enough liabilities, by which I mean debt there, that your company could be ruined, it could be worth zero one day. So the ultimate nightmare is you buy a company, it's got a lot of debt, they have a few bad quarters, and it sort of compounds and they go bankrupt. The opposite of that is a company that has no debt and has lots of money in the bank, and they can have a few bad quarters and their business isn't impacted at all. In fact, one could argue that a company like that could suffer through several bad quarters in an industry that turns south and be in a position to have less competitors to compete again when the market comes back. So balance sheet's important. I think many people don't spend much time on it, don't look at it very much. Most people just look at the earnings, but it doesn't matter how much money your company makes in the good times. What matters often is how well your company can survive the bad times. And that's one of the things that we've learned from looking at COVID is that there's a lot of, for example, restaurants that went out of business because while they cash flowed when times were good, they had no reserves, and when things turned south, they were out of business. So without further ado, let's get into the balance sheet of RYAAY. The first thing we're going to look at here is cash and marketable securities. So cash and marketable securities is kind of a catch-all, but basically it's money that the company has access to virtually immediately. Cash, obviously, you have instantly, and marketable securities is something you could sell in a few days if you had to. So when you look here at RYAAY, since 2000, they've gone from, let's call it 500 million in cash and marketable securities up to 2016 when they had, let's call it $5 billion. So, in 15 years, they multiplied their cash and marketable securities by 10 times. That's pretty fantastic. They've reduced that amount, and probably justifiably, over the last 5 years. Now they have about $4.5 billion in marketable securities. That's still fantastic for an airline. I'm not going to say it's unheard of, but it gives the company plenty of reserves to suffer through the bad times. And this is one of the real important slides for me. And this is one of the reasons why I can suggest you buy a company like this in the middle of a worldwide pandemic. The stock's been beaten up, but the cash reserves are still there for this company. And that gives me confidence that this company can survive the bad times. During those bad times, a lot of their competitors are going to go away or going to shrink. They're going to be able to pick up maybe equipment, airplanes at great prices because they have the balance sheet to do it, whether buying other people's excess or buying, for example, from Boeing and Airbus when other people are letting their orders slip, and maybe they can jump in and get some stuff cheap. So lots of good things can happen when you have cash in a bad time, and that's where RYAAY is, and that's one of the reasons why I like this company. So before we go any further, one of the things I want to talk about is that I make trades, not regularly, but occasionally, and I don't always make videos when I make those trades. And if you've been following me, I want you to be able to keep up with what I'm doing. I want you to see that when I do these videos, I oftentimes keep track, whenever I do the wealth creation video, I keep track of how I'm performing. And you will find out in real time when I buy or sell a stock if you follow me on Twitter at Robinson Stocks. But you won't always get a video on it. If I've already done a video on a company and I buy it again, for example, I just bought more stock in RYAAY, I don't do a video on it because I've already told you why I think RYAAY is a great buy. And oftentimes something will pop up that makes me think it's a good buy again, and so I'll buy it. Or sometimes I sell a stock and I don't do a video. So for real-time information on my trades, follow me on Twitter at Robinson Stocks. I also will post videos there or articles that I think are interesting when I read them. And occasionally we'll tweet about something that's happening in the marketplace. But basically, if you follow me on Robinson Stocks, it's to get real-time information on my trades. Also on the bottom right, you can see a list of my subscribers. I want to thank everyone for subscribing. I think it's really cool that I'm up to 360 subscribers now. The channel continues to grow. I think that's very fun. This map is a map of my known subscribers. I've never asked for any money. There's no commercials on my channel. But what I do like is to see where my followers are around the world. In the last month, I discovered somebody's from Germany and somebody's from Turkey. For some guy in Phoenix who's making videos in his living room to have followers like this from all over the world is really sort of ingratiating. If you're following me and you like my videos, if you made any money off any of my videos, just drop me a line and let me know, where you're watching from. You're from Sydney, Australia, or especially if you're from Africa, because I don't have any followers from Africa yet. And so if you're from Cairo or South Africa or Kinshasa or wherever, let me know where you're from. After we're done talking about cash and marketable securities, the next thing I look at is current assets and current liabilities. So current assets is an accounting definition for money that you have or will have in the next 12 months. Current liabilities are money that you owe or will owe within the next 12 months. And so what we like to see is that the current assets are larger than the current liabilities, and hopefully by some margin of error. What you can see here is that up through 2018, and by the way, when I say 2019, oftentimes that's 2019 calendar year or accounting year, and that's not the same thing as, the accounting year isn't always the same thing as the calendar year. But what you can see is that this company's always had a very nice margin between current liabilities and current assets. That has flipped in the last year, but again, that's because of COVID. We still have this $4 billion in current assets, and the difference between current liabilities and current assets is marginal, and not all of that money is due today. It's not, they don't necessarily have a shortfall in cash flow today. It's just that they might in the next year. So again, this is one of the reasons why this stock has gone down in value. It's not a big problem at this point, but it's something that you watch. And if you saw these numbers continue to broaden the other direction, you might start to get nervous. But for now, I understand that, they've had this tremendous downsizing in revenues due to COVID, a reduction in profits due to COVID, and they haven't been able to reduce their costs quite as quickly. But they're working on that. They're working on getting the revenues back up, and they're working on cutting their costs as they've cut their production. So not the end of the world, but we're looking at it. This slide, current ratio, is another way of looking at the exact same information on the last slide. It's current ratio, which is current assets divided by current liabilities. And this is just a tool that's used by people who analyze companies just to get a sense for how safe you are. A current ratio under 1 is a bit of a problem. We're very close to that number. A current ratio of 3 means you may not be using your money very efficiently, and you'd like to be somewhere in between. You can see here that what I've done is I've ranked every company that I've looked at by current ratio, and you can see that this company is in the bottom 10% of companies in terms of current ratio. Again, that's, I think, unique to COVID. It's generally in the top. It's generally about average, this company, but it just shows that this company does have a lot of stress, which is one of the reasons why the stock is so depressed. Again, not necessarily room for concern. If you'd seen this current ratio of 0.75 or 0.5, you'd be very, very concerned, but it's not really in that range. This slide looks at what I call the debt analysis. What I'm looking at is current liabilities and long-term debt here. And I just want to get a sense for what's going on with the company. You'll see that current liabilities have gone up every year since 2000, effectively, 1 or 2 dips. Basically, they've gone up every year since 2000. That's often indicative of a company that's growing. If a company is growing, then they're going to have more employees every year, and in this case, more planes every year, and more accounts payable every year, et cetera, et cetera. And so you sort of expect that that's going to happen when the company grows. But what's interesting is that while that's been growing every year, the company's long-term debt has basically been static since 2011. And that's really exceptional for an airline. Airlines are very capital-intensive businesses, right? They need to be buying planes with some consistency. They need to be buying equipment that supports planes with some consistency. And for this company to have grown like it did from 2011 to 2020 with, by the way, with increasing the cash reserves and also maintaining a flat debt line, tells you this company's done a lot of things right. And this is one of the reasons why I have confidence in the management of this company. I believe they're going to manage their way through COVID, and they're going to come out the other side a stronger, better company. And this is one of the slides that kind of diagnoses that for me and tells me, hey, these guys have managed. They're not just borrowing money to grow the business. They're growing the business intelligently, as demonstrated by the fact that they haven't piled on the debt to do it. One of the real important things, and really maybe the only really important thing that comes out of having a bunch of debt, outside of the fact that somehow in the future you have to repay that, is the fact that every year you have to pay interest on it. And that's what can really damage a country. These interest payments can become so large they choke you, and you can't earn your way out of it, right? So that's the part about debt that bothers us, is the interest payments kill us. Well, if you look at this company, the interest payments, sort of exploded up, and now interest expense has gone down basically every year until 2014, and it's been pretty consistent even since then. I guess it's actually gone on every year up till 2019. Now it started to go up again because of COVID, but another sign this company is managing itself well is the fact that they're not taking on debt, and they're lowering their interest rate as the interest rates have gone down through the economy. So it's a good sign. The other thing that's interesting here is they actually have interest income. Not many airlines have interest income to offset some of their interest expense. And so this is a very solid company. Again, we recognize what's going on with COVID, but generally speaking, this is a very, very solid company. This slide is, a bit troubling. So the interest coverage ratio is looking at the company's income, and that income as a multiple of their interest obligations. And you see that I've got a minimum interest coverage ratio of about 1.5 times. So I want to have $1.50 of income for every dollar of interest that I owe as an absolute minimum. And this company has sort of danced around that line since 2014, and in the last couple of years has dropped below that. That bothers me, especially now that they have an interest coverage ratio of less than 1. That tells me that this company is a bit of a problem. But again, I understand what the problem is. The problem is their industry got shut down by COVID. I fully expect that in the next 18 months, this will shoot back up over it. Again, the company has $3.5 billion in cash, or $4.5 billion in cash, which will cover them through some of these shortfalls. And I think will allow them to come out stronger. So again, it's one of those things where you need to look at everything that's happening, and you need to look at it in context. Don't ignore that the company has a negative interest coverage ratio, but that's potentially a reason for opportunity if you understand what's going on and you believe the company can come out the other side. Again, one of those things that we look at. This is another way of looking at the same point. This is interest expense as a percentage of operating income. So I want to see the interest expense in line or appropriate for the amount of operating income the company makes. When it gets too high, it becomes unsustainable. But for a little while, you can do it if you have enough cash reserves. And you can see with this company, their interest expense as a percentage of operating income is not too high. It's in the safe range, which leads me to believe we can come out the other side. So again, if you look at the last slide that we talked about, which was the interest coverage ratio, you see that's a red flag. And so you give the company a score of 1 out of 4 on that category. But then you look at it, that same sort of metric through a different prism, which is interest expense as a percentage of operating income, and you say, okay, well, that's not so bad in this position. And so you sort of have to kind of sift through all of this and come to some conclusions. And that's what I've done with this company, and why, again, I think that the balance sheet for this company is solid enough that it's a good investment at this price. This is debt to equity ratio as it relates to other companies that I've analyzed. You can see this company is not far from the top 25%. It's pretty solid in debt to equity. In other words, it has relatively little debt for the amount of equity that the company has. It's not out of line. This doesn't strike me as, so let me sort of recap. RYAAY has a lot of cash in the bank. They have not piled on debt for the last 10 years while they've grown the company very significantly. They have a very rough patch due to COVID. Their interest payments are probably a little higher than we'd like relative to their current production, but they're not relative to operating income, and they're not relative to production in a healthy economy. We all believe the economy is going to recover, hopefully in the next 12 months. And I believe that RYAAY has plenty of cash to survive even 2 or 3 years of a downturn as related to COVID. And I think that if a 2 or 3 year protracted recession were to happen in airfare in Europe where RYAAY operates, what would happen is a number of their competitors would go to business first, which would give RYAAY some real pricing power, which would allow it to survive and recover. And that's sort of my whole thesis here about this company and why I think that it's a good buy at this price. So that's my analysis of the balance sheet for RYAAY. Hopefully you enjoyed it, and I'll talk to you soon.